I want to thank everybody for coming today. We're blessed to have Eric with us today, and I'll throw it over to him in a second. But again, one of the reasons why we do these recordings is we like to share with you the people that we're drawing information from. So we like to bring them to the forefront and let you guys get the exposure of people we're relying on to help us make good decisions with your resources and your capital. Today, we're blessed to have Eric. He's a CFA with McKay Shields. We're going to concentrate today's presentation on munis, and we think municipal bonds, excuse me. We're using an industry term, try not to do that. So I'm going to throw it over to Eric to give a little bit of his background, and then we'll kind of dive into the material today.
Well, first of all, thank you, Joe, for having me on and allowing myself and really representing my team here to be stewards for the municipal bond market. I'm sure we'll cover a lot of it today. By way of background, I'm Eric Snyder. I am a client portfolio manager at McKay Shields. McKay Shields is a wholly owned subsidiary of New York Life, which I'm sure is a household name. My team manages municipal portfolios totaling around 76 billion worth, and most of those are actively managed. I serve to essentially interface with the street. I am where portfolio management in a way intersects with the mouthpiece of the team. So I'll stand in a lot for them, write a lot of our commentaries, thoughts, and other efforts as well. So again, I'm really thrilled to be here. Joe, thanks for having me on.
Oh, we're excited to have you here. So let's kind of just jump into it and start out with the basics. So, kind of getting into what are muni bonds, how they differ from other types of bonds and investments. I think there's a lot of misconception. I know when I'm talking to people when it comes to the difference between a regular bond and a muni bond and kind of what sets them apart. So can you spend a little time on that?
Yeah, absolutely. It's a great starter question. So, what jumps out at me first as an answer here is that municipal bonds are generally bonds that pay interest that is exempt from federal income tax. So that's the big hook and why so many individual investors seek them out. The bonds themselves are tax exempt. So to evaluate them, what you'll want to do is look at the bond's yield. And if that bond has a 3.5% yield, you're keeping all that. That's after tax. It's commonplace and convention to evaluate a municipal bond by its tax equivalent yield. In other words, you take that 3.5 and you gross it up by your tax rate. So that would mean that you'd have to find a taxable bond, let's say a corporate bond with a yield of 5.9% in order to get the same income stream. So that's first and foremost. Overall, a little bit of the background in munis or muni bonds or municipals, however you want to refer, I'm fine with that. But they are really for financing long-lived capital projects like roads, bridges, airports, schools, hospitals, water treatment facilities, power plants, etc., right? Essential items in a community, one could say. They're really split between, two big, cohorts, what we call general obligation debt, which is just backed by the full faith and credit, say like a state bond or your local city issuing a bond, and their ability to tax. Also, you have revenue bonds. Revenue bonds are basically secured by some kind of a future revenue stream. It could be dedicated tax like sales tax or hotel occupancy tax or gas tax, et cetera. It could be tolls, or it could be some other, miscellaneous user fee generated by a project. Overall, I would say municipal bonds, Joe, are largely high grade, to characterize that it's mostly AA rated versus if you go over to the corporate landscape, it's mostly BBB rated. So there's a quality differential. And as a result, and I know we'll probably talk more, but historically municipal bonds, because of that high quality essential nature, they have a default rate going back to 1970, at least according to Moody's, of about 0.15%. So it's a pretty negligible rate. Corporates default at 10.72% over that same time span. So that's a big difference, a 71 times multiple, if you will. So that really differentiates the muni space against other areas in fixed income.
Wow, you threw a lot in there. So let me hit a couple of those things. So Eric used the term of yield, which if you think about that, that's just the interest you're going to get for owning the particular bond inside there. And then he started to dive into the risk parameters of the bond, which is good. Can you expand a little bit? So looking at it from an investor standpoint, and then we'll pivot to like how you manage it, but you hear all the time, at least we do, or we used to, not so much anymore. Hey, there's governments that defaulted. Like you said, their default rate is really, 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 really small. And those in the industry know that. But the ones that you do hear about, like echo throughout the, Orange County comes in particular, which I don't think it actually defaulted, but echo really loud. So if you're an investor and you're sitting across the table and you're, New York Life person, or somebody comes to you and says, hey, I'm thinking about investing in muni bonds as the individual, what are some of the things I should be looking at through the individuals investors? And we'll pivot over to how you guys manage the portfolios and stuff like that.
Yeah, as far as an individual and how they should take into context some of the headlines that you see, because you're right, Orange County was a famous story, Detroit, Puerto Rico. In other words, when a muni bond defaults, you're right, it makes headlines because it's like this pretty rare event. In corporates, it happens quite often. So munis often outlast the headline risk is really how I would approach that first and foremost. You have municipal credit that has a lot of strength, but it often can be when those defaults happen, maybe the subject of kind of a casual observer, maybe overstating the impact, or in the case of today's marketplace, maybe emphasizing the slowing economic cycle. But what that ignores is that municipalities often have significant cash reserves. They have the ability to raise revenues and cut taxes. They have a diverse amount of revenue streams coming in, and it keeps keeps most of these projects and municipalities afloat. So that's one thing. And as far as what investors really should look at, we think it makes sense today to take a look, at least in the sense of a commingled vehicle of finding someone that can play offense. When you have these types of events, really doing a deep analysis and using their expertise to take advantage of these dislocations when they happen. For example, with Orange County, when that had financial trouble in the mid 1990s, any bond with the name Orange in it also went down. Orange County, New York, being a famous example of that. So somebody who can spot that idiosyncrasy in our market and take advantage of it is something that investors should go to look for.
That's awesome. You know what? Again, there's a lot that you went through, so hopefully everybody kind of caught a lot of those different things that you're addressing it. So I'm going to pivot a little bit and kind of talk about like managing it on the portfolio side. And I know there's a lot of talk around interest rates today. And then as a bond manager, when you're looking at the environment, what are some of the metrics that you concern yourself with, or some of the things that you're looking at that you can talk about, that when you're going out to the market and building the portfolio for the clients, what are some of the things that you're looking at and you guys are doing over there at your firm?
Sure. Yeah, we're really active managers. So just from the broadest perspective, and we can kind of funnel downward through this conversation. But as I just kind of talked about Orange County, right? It's a very inefficient marketplace informationally. It's quite fragmented. It's completely over the counter. So there's no stock exchange equivalent for municipal bonds. You really get on the phone and call Wall Street and look for another trading partner on the other side. It's not as simple as buying a stock, on the New York Stock Exchange every week. What happens in our market is bonds are issued. They trade a lot in the initial stages. Then investors put them away and you never see them again, despite or save for extreme periods of dislocation. So that means a lot of bonds never see the light of day. They don't trade. And there's about 1 million bonds roughly in our universe coming from 50,000 different issuers. So the point I want to make is there's a limited capacity to buy what I'll call like a legacy bond that hasn't been heard from again. So that capacity, it's fleeting when it's there. You can't really always get everything you want when you want it in our market. So being highly active for us, first and foremost, is important when those opportunities arise. Really, we see opportunity every day for price discovery in our marketplace, no matter the direction of treasury bonds or other aspects of the market. And we look at our market, like it's really 50 unique markets, right? It's, municipal bonds are more subject to technicals. So the new issue supply, coming out in the marketplace, demand from investors, when those tend not to align, there tends to be a lot of opportunity. Plus, you can also see there are some states that have higher top marginal tax rates where demand never really ebbs, or it doesn't ebb to the same degree as it would maybe in a locale with no state income tax or a lower tax. So we're looking at technicals. We're certainly, as a credit research shop, carefully examining each and every new deal in the marketplace, probably passing on many, and being very, I think, credit oriented. It's constant surveillance, and we're trying to identify as best we can some sort of a mispricing. Like I said, there's mispricing opportunities to discover in this market every day. You never know who's going to sell, what they're going to sell, and how urgent the need for the proceeds will be, and all that. It can create very interesting opportunities.
That's awesome. So you you made a couple of comments like disconnect, and one of the ones I think I loved is that you get on the phone and call. So are you as concerned, like if the let's just use an example of somebody looks at a small town or medium-sized city that's issuing a bond, they go out and get a credit rating. Is that a concern for you? Because you made the comment, you're getting on the phone, you're doing the due diligence, you're looking at that, you're trying to find those disconnects, I think was the terminology that you used, as opposed to somebody else doing the research for you.
Sure.
I heard you correctly.
That's it. So our research analysts, each one covers their own unique sector in our marketplace. A sector could be transportation or hospitals or education and so on. And they have a list, right? They know their favorite bonds. And so that list is key. We can basically go out and try to find those bonds when they're less expensive to do so, or when there's an opportunity to make that happen. So in your example, a local city might have a credit rating on it. We might think that credit rating is we might have a better viewpoint on the bond in this case, and someone might be out trying to sell that bond and not appreciating, something we've seen, right? So
Yep,
that's an
yep,
example of how we can capture, or the opposite could be true,
yep.
at times, and it could be something that we're willing to sell. So it works in both directions, but our credit drives, every single security that ends up in our portfolios.
Yeah, no, that was, I'm glad you hit on that point, because I'm not sure if everybody caught, you made a comment earlier that municipalities have the ability to increase taxes, throughout the road. So if there's a disconnect, you have a rural affluent area and they have the ability to increase that, you could see an opportunity that somebody else doesn't see inside there, which is just awesome inside there.
Exactly.
So as we kind of wrap up or kind of come to the end here, is there any advice that you would give to people that are looking into muni bonds for the first time? I know, so I guess what I'm getting at, and I'm going to steer the question a little bit,
Mhm.
because as we getting further and further in business, I'm obviously dating myself with the Orange County question, but we have several clients that are now selling businesses, and they may have had most of their money in their business for years, and are now getting exposed to obviously taxes and things of this nature. And they're going from a net worth to actually having cash in the muni bond market. So as somebody's looking that's new into the space, or even the retiree that has a larger non-IRA account type scenario, what advice would you give to them as they're starting to venture out into this area?
Yeah, for someone new, I would say, what took you so long? But in all seriousness, it's an asset class where you take a long-term view. It's very resilient, as we discussed in a few prior examples. And just to make examples out of that, in the rate hiking cycle that we've been in the last couple of years, really going back to the beginning of 2022, it's maybe people know it, maybe they don't, but municipal bonds generated excess returns of, call it, 1.6% over treasuries. Or back in the credit crisis, so we're going back a little bit to 2008. Municipal bonds outperformed their corporate counterparts by about 3.5%. So it's been a very resilient asset class in different economic cycles. It's looked at as a defensive asset class to own as an economic cycle is winding down. So I always tell investors, have a long-term view, and be disciplined. Meaning, when you have some weakness in our market, we're a very resilient asset class. It's usually a buying opportunity, somewhere in there, right? So try to be disciplined, try to be willing to invest when others are selling. And I would say, as far as what kind of people ask us, how do we get involved? I would say, in the context at least of a commingled, type of a vehicle or approach, look for something with good diversification, something that's liquid, something that's built, using that credit research lens to help you navigate some of the troubled areas. Have someone willing to define relative value for you, embed tax efficiency, and keep your yield, your income stream, I should say, strong. So, those are just a few of the pointers I would give. But overall, we've had when you're building a portfolio with munis, and I think this is worth adding, over the last 30 years, the correlation between price movements in muni bonds versus stocks, using the S&P 500 as an example, is about a 0.17. The closer you are to zero, that's a very low correlation. So as you build a portfolio, it makes sense possibly to include this as a building block for improving your risk profile, your return profile, your diversification.
That's awesome. We appreciate it. Again, our goal here is to bring to the people, our clients and potential clients, people that we're tapping into. We have access to resources. So I want to thank you guys again. You guys have been a great partner. We appreciate all you do for us. And thanks so much.
Thank you very much.